Silver is approaching a moment that rarely appears in market history. Not a normal breakout, not a speculative spike, but a structural repricing. According to Michael Oliver, the metal is no longer trading within its old behavioral range. Instead, his technical work suggests silver is transitioning into what he describes as a new reality, one defined not by gradual appreciation, but by acceleration. Oliver's projection is precise and unusually aggressive. He believes silver could advance from its recent all-time high near $94 toward levels between $200 and $500, potentially within the second quarter of the year. This outlook is not based on sentiment, inflation narratives, or supply headlines, but on long-term momentum structures and the historical behavior of silver during genuine monetary bull markets. What makes this particularly important is the framework he's using. Oliver is closely monitoring silver's relationship to gold, a relationship that has historically shifted violently when precious metals enter a true monetary phase. In past cycles, silver has not simply followed gold higher. It has outperformed it, often suddenly and dramatically. With gold expected to accelerate even further into 2026, Oliver believes silver is positioned to exceed expectations at a moment when investors least expect it. In this interview, Oliver explains why the long, exhausting consolidation that defined silver for decades may now be complete, how historical spread breakouts against gold have preceded explosive moves, and why stress inside the global bond market could be the catalyst that turns technical pressure into a full-scale repricing event. If you value disciplined market analysis grounded in history, structure, and momentum, make sure you're subscribed and stay with us through the full breakdown.
It is not a normal bull market. We've been telling our subscribers that for well over a year, but it's gone up in an arm wrestling manner, both gold and silver. You know, they shoot up a couple $100 in gold or $10 in silver, and then you go sideways for 5 months and bore the heck out of everybody, make people think it's over. Then you do it again, and then there's another congestion zone. And it's been laborious. It's no longer laborious. It's going to go vertical. There probably will be, I think, a correction in this process. But our technical work coming at these markets from different angles, by the way, not just looking at the price and the momentum of price, but at the spread relationship between silver and gold. You know, the baby metal mama currency and the big old mama currency. And silver's vastly undervalued, historically speaking, to its prior relationships to gold. And I think that's going to change dramatically and suddenly. And that's the key word, sudden. I think we're in one of these, what we call a move to new reality. It's occurred in other markets. We found an instance of it occurred in copper back in 2005 to 6, where copper, in a matter of a couple quarters, quadrupled in price on its own, without help from any other market, and went from an old, multi-decade horizontal reality and just said, boom, I'm out of here, and quadrupled, you know, a new reality.
Yep.
Lead did that in 2007, which was ridiculous. But, you know, it did. How come silver has still been caught in that half-century, $50 to $4, $50 to $4 range, and only recently has broken out?
Thank you. That's the question, yes.
I think it's going to a new reality, and our measurements, based on a variety of factors, not just looking at silver itself, is that this move is going to take us to a new reality. And much of it is going to occur in a few quarters. And we begin that clock. In other words, where did the couple quarters begin? We begin it at the November close. And the reason is, it was at that point in time that when we looked at the relationship of silver price to gold and plotted it as a spread, you know, ounce of silver into an ounce of gold, it's a certain percent. Okay, you just simply plot that chart, and it was a ceiling that went back years. Quite a few handful of years, where you go up and bump a certain level and bump a certain, silver just couldn't get above that value of gold. It broke through there in November. We've gone back and found other few instances of this type of behavior where silver said, I'm out of here, okay, versus mama gold. And it went vertical for a couple of quarters after that. This time, there's other factors in play as well, fundamental, macro technicals, and so forth. But we've been arguing since November that what we're about to see in the next handful of months or so, you know, 5, 6, 7 months or so after that November breakout, therefore starting in December, A vertical move in silver that's likely to take your breath away. Not just to go up to 90 or 100, but go into a couple hundred, possibly 300 to 500. There's some rationale for that, by the way. Various angles of analysis give us that conclusion. And we think a lot of that's going to occur by the second quarter of this year. Obviously, that's not going to occur in isolation. Gold's also going up. And I think gold at 5,000, for example, which is headed for now probably, is way low. To give you an example, stupid one, but I've put it out before. People think that's his target. It's not. If you go back and look at the bull market from 1976 to 1980, it was an eightfold gain in gold. 8 times. Okay. But look at 2001 to 2011, eightfold move from the prior bear low to the bull market high. Our bear market low was 1,050 in December 2015. Eightfold is what? Okay. 8,000 plus. That's just to do what gold has already done twice in the last 50 years under far less dramatic fundamental conditions. Eightfold. Right now, we're only a little past fourfold. What if gold goes to 8,000 again and silver goes up, breaks out versus gold, which it's done, and goes up to, 3%, 6%. Those are numbers it was at in 2011 when gold had that bull market run up into 2011, which was the second hit up at 50. Silver spread then was 3.1% of the price of gold. Right now, we're just 2%. In 1980, when it had that surge to $50 for the first time, it was 6.5% of the price of an ounce of gold. Wow. Consider those numbers, okay? But the bigger picture, I think, really is the one people don't talk about, and that is we're headed for a monetary crisis. I think fiat currencies are in jeopardy. We know, if you haven't been paying attention, and I'm sure you have, and your audience as well, the T-bond market is on an ambulance stretcher right now, okay? Not just our bonds, the Japanese bonds effectively crashed today, exploded in yield. UK bonds don't look very good. The Western world bonds don't look good. We're no longer talking about a mortgage crisis like 2007 to 8, where this mom and pop lost their home, et cetera, et cetera. We're talking about government debt, markets that dwarf the stock markets. And if you'll look at the T-bond futures, which is what we analyze, 30-year bond futures in the U.S., they crashed between 2020 to 2022 in price. Yields exploded, okay? That price low back in October of 2022 was at 117 on T-bond futures, okay? Just remember that. In the subsequent 3 years, there have been rally attempt after rally attempt. In fact, 3 of them. The 3 is usually all you get to get up out of the hole. Fed can cut rates all they want on the short end, but it doesn't affect the long end rates. And they failed each time. Right now, we're down in the 114s, even traded into the 113s today. Our technical analysis tells us that that 3-year process of trying to base or trying to top yields is failing. And then you roll over about another 3 points or so in the bonds below today's low, which when you look at a price chart, it doesn't break below the lows we've seen over the last year or two. But you do that and you could be headed into a bond panic. Well, you can't have a U.S. debt market panic. That's like a nuclear event. The Fed knows that. They're the printers, and they print gold higher because they destroy their own money in the process of print.
What Oliver is describing here is a market that has deliberately exhausted participants. Years of sideways movement, repeated pauses, and extended congestion zones served a purpose, not to end the bull market, but to strip conviction from it. That process, in his view, is now complete. When momentum finally resolves after such prolonged compression, price behavior changes character entirely. From here, Oliver shifts from the metal itself to the broader environment surrounding it. Because silver does not move in isolation, its most powerful advances historically have occurred when pressure builds simultaneously in gold, in currencies, and most importantly, in sovereign debt markets, areas he believes are now approaching instability.
In November, the president of the New York Fed, Williams, said in a speech or press conference, the Fed is now going to start buying bonds. And his excuse was, just to provide more liquidity in that market. You look at what's going on in bonds since he said that statement, slab down, sideways, dead as heck for 2 months, couldn't move. It's like it didn't even look like the bond market anymore. The daily, weekly ranges were like nothing, comatose, meaning they were buying it, but the rallies couldn't get going. And then now you've punched through that recent set of lows. If they're not in control of that beast, and I don't think they are, that can cause wave effects in other financial markets that will cause central banks, not just Japan, here, UK, all across the Western world, to go ape. And that's what drives monetary metal.
Wow. Well, and we're about to get a new Fed head, but if I'm hearing you correctly, it doesn't matter because they can no longer manipulate the beast.
He'll print too. You know, our president wants him to
Yeah.
print. So you've got both the president and a Fed that's going to print. Well, you think, well, that's good. They're going to put out the fire. No, they're not.
Yeah.
They're just going to create more M2 money growth. Go to the St. Louis Fed website and
Right.
ask for M2, and sit back and look at that money supply growth.
And explain to the people when that goes through the roof, Michael.
Well, that's what gold is the other side of. It's real money. They can't inflate it. They can't manipulate it. They tried to manipulate silver by keeping a lid on it. And usually when somebody tries to manipulate a market, whether there's some big trader or government, and they're doing the wrong thing, and it seems to succeed for a long time, all they're doing is creating compression, so that when it finally does break through their barrier, attempted barrier, it goes even more ape on the upside than it might otherwise, because it's been held back for too long. And so it has a panic on the upside. And that's what I think we're starting to see in silver, especially silver and in gold.
This was a good article I read with the headline, "This is a sell America. US dollar, treasury prices tumble, and gold spikes as globe flees US assets." The sell America trade is in full effect, Michael?
I know everybody's going to want to blame it on Trump, but frankly, the underlying fundamentals that are decrepit and have been bad for decades is the ongoing inflation in the money units. No, we're not the Weimar Republic, but in effect, we're doing the same thing in a miniature form. You print, prices of everything goes up, bread, stock market, some things go up more, gold. If you own gold for the last 10 years, you beat the heck out of the S&P. But it's all false. It's distortions. And you can't keep playing that game because finally you'll have an accident, not really an accident, but a consequence, like in the government bond markets, that is so huge that it causes intellectual doubt among academicians, among the voting public who thought some things were going to happen on a good way after Trump got elected, but they're going the other way. Apparently, neither party works. So when nothing works and your retirement account suddenly, let's say in the next couple months on the S&P, wipes out all of 2015's gains, which is only 15%, then suddenly you as a person in the street, what the heck? It's 52 card pickup. You are uncertain. Therefore, what happens? Emotion. And when emotion comes in, whoa, that's when
Panic.
it's like a nuclear event almost. And it can be very personal to people, just like it was in 2008 and 9, except this time it's even bigger. Gold knows that. That's what's been driving it all along. This is coming.
Do you feel enough people are waking up to the reality that if they don't own gold,
No, they will. They're not waking up yet, especially in this part of the world. Right now, if I don't look at internet comments on silver, my son does that for me. I'm tired of looking at that kind of stuff. But the jabber from free analysts on the internet is sell silver, short it. It's the top. It can't go any further.
Right.
This is what they're doing is they're looking at an arithmetic chart, a dollar chart of silver. And admittedly, when you look at it, it was like, $40, $50 a handful of months ago, and it's doubled. Okay. So in a normal world, you'd say, well, that's pretty good. I'm getting out. We're arguing it's just begun. If you see a 10 to 15% drop and it looks like hell on a daily chart, buy it anyway. And if you go back over the last handful of months and every time you see a 15 or 8%, 10% drop, if you bought it instead of selling it, you're way ahead of the game. Okay? Somebody knows that because somebody's buying it, not just somebody, but bodies. But you still have this overwhelming doubt. And here's an analysis I gave my son this morning. I noticed that before silver would hit a higher, gold even, back in April, and gold went sideways for 5 months. Doubters, doubters, doubters. It didn't break down, but they capped it. And then you broke through, and then in October, you had another pause. The pause was only then a couple months, shorter time span, and then you jolted again. Same thing's going on in silver. You could have a whole year-wide pause at $35, late 2024 through early 2025, but basically a whole year of this with a 35-plus cap. Whole wasted year. You bored to death, okay? Doubted. And then it went through that and jolted up another $10 or so. It's been a layered process. But I even noticed that on day-to-day action. Take today, for example. We jolted up to $95, and they spend the whole day selling against that and dropping it back down to 93.
Right. Yep.
Except instead of it lasting 3 months now or 2 weeks now you can measure those pullbacks in hours. So things are speeding up. I suspect the T-bond event, and we've expected this all along, is possibly the event that creates the headline crisis. And if it does, we've, in our analysis of some prior surging moves in silver, for example, in 79 to 80, where it went up like 5-fold in 5 months.
Michael Oliver's outlook ultimately rests on a much larger framework than silver alone. His analysis points toward a structural breakdown in confidence, not in individual markets, but in the monetary system supporting them. When government bond markets begin to lose stability, central banks are forced into a position where intervention becomes unavoidable. And intervention, by definition, expands liquidity and weakens currency credibility. This is where gold and silver reassert their monetary function. Gold responds first, absorbing institutional demand as confidence erodes. Silver follows later, but historically, when it does, the move tends to be faster, sharper, and emotionally driven. Oliver's work shows that when silver breaks decisively against gold, the adjustment often unfolds in quarters, not years. That is the pattern he believes began with the November breakout. Equally important is the compression effect he highlights. When a market is held back for extended periods, whether by structural forces, policy pressure, or persistent skepticism, the eventual release does not produce orderly price discovery. It produces overshoot. That is why silver's prior advances have not been linear. They have been violent. Short pullbacks, rapidly absorbed, followed by renewed upside, a rhythm Oliver believes is already forming. Looking ahead to 2026, his outlook remains constructive across the entire precious metals complex. Gold, in his view, is still early in its monetary phase, with historical precedent supporting far higher levels than current projections suggest. If gold continues to advance as expected, silver's historical tendency to outperform during late-cycle expansions becomes increasingly relevant for investors positioning ahead of that move. For well-informed market participants, this is not about chasing price. It is about understanding structure, recognizing when a market transitions from accumulation to repricing. Oliver's analysis suggests that silver may now be entering that second phase, not quietly, not gradually, but in a manner that forces reassessment across portfolios that have ignored the metal for decades. If you found this breakdown valuable, support the channel by liking the video, sharing it with others who follow the metals space, and subscribing for continued deep dive analysis. Thank you for watching, and stay alert, because markets rarely announce a new reality before they enforce it.